All right, big question that I want to ask all of you, and I ask myself, and I ask the markets. Did the markets actually forget that it's earnings season? Because we're not hearing a lot about what's going on in earnings. We're hearing a lot about what's going on geopolitically. We're hearing a lot about what's going on with the transition from one administration to the other. We're hearing a lot about weather. We're hearing a lot about cryptocurrency. We're seeing big moves both up and down. But very little's been talked about with this upcoming earnings season, and it's because it's taken a back seat to what is more important in terms of what broadcasters think we need to be looking at, the mainstream media thinks we need to be looking at in terms of news. I want to talk for a few minutes about how most traders play at earnings seasons. I want to talk about how we, as in me, look at earnings and how you should be looking at earnings. And I'm going to end with the top patterns that we're seeing for the rest of January, which is only a couple weeks left. All right, so let's get right to it. I got to say this. I've said it before. I'll say it again. The wrong way, the way you do not want to trade earnings. Everybody starts out this way. They think they see a pattern where something pops up or something pops down in terms of price. And first we trade stocks, and then we look at options. And most option traders end with the idea that, options, they're just like a stock, but they're cheaper. and while part of that, the very, very first part of that is right, that's where most people end their options education. It's just like a stock, but it's cheaper. But what they don't realize is that options are not just about price. They're about time, they're about volatility. And if you want to trade earnings, you want to trade it the right way, you got to master all three concepts. If you're just going to think about price, do yourself a big favor, stay with the stock. I'm going to show you why here. Because what most people do is they buy right before an earnings announcement expecting a pop. And they think, if the stock pops 5%, then the option must pop a lot more because it's cheaper. Right? What they don't realize is that buying right before earnings, they typically end up buying the option right before it expires, and therefore could take a huge risk. Now, I have a blue square in this particular stock symbol here. All right, this is a past symbol, so I'm using it for educational purposes. I want to show you what happens when you buy right before earnings. You're typically buying a high in what I call implied volatility, options volatility. Now, I want to show you what happens when you buy right before an earnings report, and then the very next day. This typically happens. The options volatility gets sucked out of the room. And guess what else gets sucked out of the room with it? All that time value that was in that particular option. And depending on whether you bought calls, whether you bought puts, or maybe you bought both, thinking that I'm going to make money regardless of which way the market goes. If it doesn't go far enough, in most cases it doesn't, you're destined to lose money after an earnings report drops. So, here's what we want to do. We want to get in before the crowd, all right? Before the tourists come in, we want to get in. And we want to get out before the tourists all start crowding in. So the right way to trade an event, an earnings report, is to get ahead of it. And we know this because while it's harder to track direction on a stock, it's pretty simple to track direction on implied volatility and on options premiums going into an earnings report. And what this chart tells me is get in a week or two before earnings and get out right before earnings when the bubble is at its peak. Now, what we do is we have the ability to go in and look at this information. And we can dive in and we can look at my earnings terminology is when does the initiation of an option start? When does that move higher start? When does it end? That's termination. What is the expected volatility increase? That's magnitude, right? When I look at beginning and end and I get that magnitude, I can come up with an ROI projection. And then finally, I can take all that information and I can go back and historically look at how often this actually happened. So here's my patterns for the next few weeks. The top three I have in red. They are mildly bearish. Schlumberger, you might say, but wait, Tom, oil is up. Just because oil is up doesn't mean oil companies are going to be up. If oil spikes higher and the price at the pump or the price at the distribution center doesn't move up along with it, that could cause a temporary margin decrease for the company. Keep that in mind. Schlumberger, for 3 of the last 4 earnings quarters, this stock has moved lower. All right. It has moved lower in price. 3M, those sticky pads? Yeah, they do more than sticky pads. They're surgical, they're medical, but they also, for 4 of the last 4 earnings quarters, have moved lower, right? By the tune of almost 20% lower. And I'm talking about an option move, an average option move. That means 20% higher for you put traders out there. And then finally, take a look at Netflix. So Netflix has a 3 out of the last 4 earnings cycles has moved lower as well. And I'm talking about not after earnings. I'm talking about the week prior to earnings. The stock has dropped on all 3 of these. Let me give you a little bit more detail on this. We'll take a look at Netflix. This is Netflix. Now, I've looked at the Netflix chart, and it drops a little into that week. And this is what happened on the last earnings cycle. So on October 9th, had you have bought the at-the-money puts, right? That was the 725s, folks. You were paying an average of $28.35 for the put. Wow, that's expensive, Tom. Yeah, but look at the stock price. It's $725. And plus, do you really want to short that stock? I wouldn't want to. I would want something that gives me limited risk. Now, this is again 9 days out, 9 days prior to the earnings report, 9 calendar days. That takes a weekend in the account too. Look what happens the day before. You fast forward 8 days. That 725 put that you paid $28.35 for is now going for almost $47.15 to $48.95. It has literally, all right, is literally gone up almost 70% in value. What has the stock done? The stock's been trickling down over the week. This is right before the earnings report comes out, folks. Look what happens if you stay in just one extra day because you think, when that earnings report comes out, these traders must know something. They don't, all right? Option traders are merely gauging the level of fear and greed that's happening in the stock because the earnings came out and they weren't so bad. And look what happened to the stock price the very next day. Drove those puts down to a penny. So again, what is the summary of earnings, right? Emotional gamblers, they enter on earnings day. Yeah, they're going to be right every once in a while, but even a clock's right. Even a broken clock is right twice a day. Smart traders, we enter before, somewhere between 1 and 2 weeks before that earnings announcement comes out, and we're getting out when everyone else is getting in. Right there, right before the earnings happen, right? And again, that's the summary, folks. Last thing I want to mention again is that I want you to be on the lookout for my take on the cryptocurrency markets, for Bitcoin, for Ethereum, for the 3 catalysts that I think are going to drive this market higher, despite double-digit moves we've seen from top to bottom. I expect that to happen and more. And by the way, the biggest announcement, the biggest thing I want to talk about later this week is how I am trading this cryptocurrency markets, right? And I say the word trading, not buy and hold, because there's something that's changed recently that I'm now adding to my trading arsenal. So be on the lookout for that. I'll have that out to you soon.